again, everybody. I hope you've all had a great lunch. This is a really fun topic, the most early stage crucible moment in transactions and the role of blended finance therein. And the whole point of design funding, in case you haven't picked up on it, is to put more transactions out there into the ecosystem for people to invest in. And as our introducer said, there are a lot of reasons why it doesn't happen, why deals don't get to market. A lot of times people don't even try because the cost of the deal dying 6 months into trying to work on it is huge. And sometimes these are things that people aren't sure are going to work. So there's an awful lot of reason to do design funding, and we're really happy to be talking about it this afternoon. I'm going to ask each of our panelists to introduce themselves briefly, and then perhaps if you've had any experience with design funding, just give us a flash preview of it, and then we'll circle back and dive in more in detail. And Maya, let me ask you to go first, since you have the disadvantage of being there on screen. And I hope you can hear us well. We can certainly see you well.
Wonderful. Thank you so much, Lisa. So thank you so much for inviting me to join this panel today. I'm sorry I can't be there in person, but I'm delighted to join virtually from Geneva. So yeah, I'm the CEO of the UBS Optimus Foundation, and maybe just briefly to tell you who we are, we're an independent foundation, but we're aligned with UBS, the world's largest wealth manager, and we've been pioneering ways to tackle some of the world's most pressing social and environmental problems. For the last 20 years, we've been funding programs with proven potential to make a big difference in education, health, and the environment. And we have over $350 million under management, and our approach really looks at three main pillars, and I'll get back to how that links into the design funding topic that we're discussing today. So we do early stage impact ventures, so grants and social investments into these early stage programs. We then scale them up through partnerships, whether that be through governments, collective, and critically through blended finance. And then underpinning it all is really our impact transparency lens, which is around common metrics and benchmarks. And so blended finance is critical to what we do, and we're in a unique position that we're linked to a wealth manager, so we can leverage philanthropic funds from clients to catalyze private funding into development. And we can work with other areas of the bank to develop these structures, whether that be funds or structured products, and combining our philanthropic first loss to de-risk and enhance returns with Optimus social impact expertise in education, health, and the environment. In terms of our design funding work, maybe two things that I'll highlight. One is really support to social enterprises to try and build up their business model while proving that they can actually have measurable outcomes. So we've worked with Fair Ventures Social Forestry in Indonesia that puts concessions with degraded land back into use by working with local communities to basically conserve the remaining high-value conservation forests, generating revenue from the sales of carbon credits, but also then generating livelihoods income through timber and cash crop plantations on degraded land plots. And that critical design funding to get to the to prove that business model has been a fantastic way for us to actually show that that has the potential for financial viability, and then actually attract investors into a blended finance structure going forward. So that's one way where we do that early stage building pipeline opportunities. The other way is actually supporting larger initiatives like the one that was just mentioned with the Monetary Authority of Singapore and Convergence by working to launch calls for proposals to actually attract a pipeline of opportunities in the blended finance space. So really looking at providing grant funding, providing first loss capital or guarantees to help identify opportunities. And one of those was the SDG Impact Finance Initiative that we launched about a year ago, and we've received more applications that we anticipated, and we believe are going to be critical to develop that next generation of pipeline opportunities to help us reach the SDGs. I'll stop there for now, but I have many more examples that I can share a little bit later.
Thank you so much, Maya. There's a lot going on there. A couple of design funding windows, some direct engagement in design funding. Let me start at the very end with Srini, and we can come in my direction from there. Please
Thank
go
you.
ahead.
I'm Srini. I head Asia for British International Investment. We are the world's oldest development financial institution, started in 1947. We used to be called CDC, Commonwealth Development Corporation. We operate in South Asia and Africa, and more recently into East Asia. We are a true development institution, and we take a development impact very seriously. We don't put our commercial objectives ahead of our development impact. I think our objective is to be much more catalytic in nature in the way we operate, take greater degree of risks, and before the projects come upstream and start generating cash flows. Our total balance sheet is around $12 billion, entirely funded by British taxpayers' money, and we're wholly owned by the government. Thank you.
Okay, so far we have a private catalytic party, a government-owned catalytic party, and over to you, Shilpa.
Good afternoon, everybody, and thank you for having me here at the panel today. So myself, Shilpa Gulrajani, I head corporate development and sustainability for BNP Paribas. BNP Paribas is a global bank across corporate and institutional banking, asset and insurance, and of course we have the wealth side, so wealth management and the retail banking. In context of the topic, actually we find ourselves pretty well, I would say, positioned, because the beauty of being a commercial bank is that you have on one side access to the nodal point, which is the corporates, which ultimately come up with the projects and which need to be financed. You have the institutional investors on the other side, and you play a very critical role of connecting the corporate clients and bringing in the institutional investors. And then, of course, the entire ecosystem whereby you need the grant finance, the grant money, and then the philanthropy funds, and of course the catalytic funding that we are referencing precisely today. And last but not the least, we should not miss out on what we touched upon, the individual wealth investors, very critical for this part of the world, where there is a huge concentration, of course, of wealthy individuals, but beyond that, increasingly with the next, there is a huge focus on channelizing this kind of wealth and money into the right avenues. So I think we will touch upon this as we move forward, but again, once again, pleasure to be here.
Thanks very much. Lisa, over to you.
Yeah, thanks, Joan, and good afternoon, everybody. So ADM Capital, which I work for, is a Hong Kong-based private credit firm which has been working across Asia since 1998. There are various aspects to ADM Capital. Another is the series of OECD-focused land and farming funds based out of London, the KIBIS funds, and then a catalytic environmental foundation, which I established for the partners in 2006 when they really didn't know how they could address the sort of the hairy underbelly of the Asian growth story through their funds. So we set up this non-profit entity. For many years, ADM Capital itself, in part because of the, well, entirely because of the sort of leanings of the partners or the interests of the partners, they've integrated climate and E&S risk assessments as well as KPIs across the lending and PE platforms. And compliance has been incorporated into loan covenants. So we do consider this part of our fiduciary duty, and that was discussed at length in some of the other panels. What is fiduciary duty for ADM? It is managing E&S risk along with legal risk, financial risk. For us, it's just as important. But I personally transitioned out of the foundation last November to help ADM take a next step with a new vehicle, which is ADM Capital Climate, which builds on the three legs of this group: the foundation, the private credit vehicle, and the food and farming funds. Feeling the urgency again that we've heard so much about, and the opportunity, our first ADM Capital Climate product is a $200 million fund lending to SMEs in Indonesia specifically that support transition in the agriculture sector, so largely smallholder farmers and smaller companies. ACLF will provide credit to companies to help them grow and transform their practices. But this is essentially what ADM Capital has been doing for years through its straight private credit firms, through its straight private credit undertakings, but non-thematically. This is the first time, however, that we've set impact targets, and those are improved livelihoods, gender, better land use management, and reduced emissions. So this is ADM Capital's first impact-focused fund. The overarching objective of the fund is to decouple agricultural commodity supply chains from deforestation while offering blended capital that's not available in the market and with commercial terms. And we see the commercial aspect of this as the critical piece in terms of scalability and replicability. In terms of design funding, we've benefited through the years, over the years, really since 2016, from a series of Convergence grants, three Convergence design funding grants, to help us develop a joint facility, a partnership facility, and then most recently ACLF. So thank you, Joan.
And thank you to our donors. Okay, let's back up for a moment. I'm going to ask Maya to walk us through a specific design funding program and maybe ask you a bit about how it works. And the one I'm thinking of is the Swiss one, affectionately known as SIFI. Maybe you can spell that SIFI acronym out for the crowd. But walk us through what an innovation window looks like, you know, how it calls for proposals and the whole thing. Maybe just give us a sense of how one of these design funding programs works in practice.
Sure, happy to. So SIFI, the SDG Impact Finance Initiative, is a public-private partnerships between two arms of the Swiss government, the Economic Cooperation Agency as well as the Development Agency, along with UBS Optimus Foundation and Credit Suisse Foundation. And it aims really to support the development of innovative solutions to mobilize finance to accelerate the achievement of the SDGs. And the goal is really to help mobilize, you know, up to 1 billion Swiss francs by 2030. So the way that the SDG Impact Finance Initiative works is that we are, in the first instance, we kept it fairly broad in terms of SDGs. It was launched about a year ago, and the innovation windows really aims to provide grants to support design funding, that is feasibility studies, proof of concept, and expansion grants for projects that are ready to scale. So really, it's going out there to the market and saying, we are have a facility that's out there to provide you that initial support to seed programs that have the potential to scale. You have to demonstrate that it is going to target a specific SDG, and you have to demonstrate that it has the potential for scale. And the rationale for this window is really to try and catalyze these early stage innovations. Some of them might work, some of them won't, but to try and increase the amount of investable opportunities out there to reach the SDGs. For us, you know, what success might look like is really programs that have a realistic prospect of scale, but also the inclusion of more, let's say, difficult or neglected SDGs that maybe have more difficulties attracting more commercial funding at the early stage. It's also about being able to build strong and trusted partnerships and generate a real collaboration across government, civil society, and private sector partners. And so this call was launched several months ago, and we were actually really surprised to see the amount of applications that were received, much more than we had anticipated. So there's a real demand for this type of funding, and then there is capacity out there to actually deliver. So we're really excited about the potential of this initiative, and we'll be announcing finalists actually later today.
Right, so the whole point of it is to bring forward the creativity that's already out there, the ideas that are already out there for structures that could exist, give them some tailwind in the form of early stage grants for feasibility or proof of concept stage work, and then let them go off to market. Hence, more pipeline for everybody else to invest in. Let me turn to Srini and ask you about BII. How do you go about building a pipeline of bankable transactions? What do you do to curate things that could later be investable by commercial parties?
First of all, you know, development impact is a complex subject. Yeah, We have come to some consensus between us and our shareholders, which is the Foreign Office, about how we measure and on a kind of a scale of 1 to 10, which we use productivity, sustainability, and inclusion as 3 main parameters. Productivity is about economies of scale and catalyzing markets. Sustainability is about our journey towards net zero by 2050. The Just Energy Transition Program, which we are deeply involved in South Africa, and we are planning to get involved in Vietnam and Indonesia and India. And of course, the adaptation and resilience journey of it, part of it really. So and of course, inclusion is about who benefits from our money. So if your combination of P plus S plus I is what we look at our development impact framework, and I think it's one of the world-class framework we have developed, and we are definitely going out and talking more about it really. It's there on our website. If you look at our overall strategy, you cannot achieve development impact unless you have different pools of capital. So we have 3 pools of capital. One is our growth, which is where bulk of our balance sheet growth comes from. As I said earlier, we never put our commercial objectives ahead of our development impact. Second one is our catalyst. A catalyst pool of capital is where we do transformational deals, where we definitely try to shape nascent markets. When I want to give you an example of what we did with Cropin. Cropin is a wonderful company in India, which we are early stage investors there, which now provides services for 4 million farmers. And it's a specialist in software for agri-businesses. It digitizes the farm management processes using satellite images, artificial intelligence, and machine learning to monitor the crop health remotely, particularly for small-scale farmers, given the fact that South Asia has got highly fragmented land, and improving their realizations, which is part of our objective. So they have digitized 7 million acres of farmland and accumulated around 2 trillion data sets as a result. It's an outstanding company, which I really enjoy monitoring it very closely. So we also have this Catalyst VC programs, which we work with venture capitalists in terms of taking early stage risks. And more than anything, we have what is called Kinetic, which is the climate innovation facility for our blended finance. Now, as far as this particular aspect is concerned, of course, on the blended finance side, now we are working with Cropin to introduce hyperspectral satellite that will give significant average of crops. But I just want to take a couple of points from what I wanted to tell you. See, the concept of blended finance in the concept of climate change, which is about climate innovation, is still in a very nascent stage in our markets. When you look at globally, 14% of the venture capital funding is going into this climate innovation. And even in a large country like India, which requires, you look at how Pakistan has struggled. 1/3 of the country is deluge. I would have never thought 3 years back, Karachi has never seen rains for the longest time. Who ever thought it? But it's a warning signal. So even in a country like India, only 1.5% is going into climate tech. So I think what is necessary is that, because of few reasons. One is lesser precedence of how things are happening and bridging the cost gap. Everyone knows offshore wind is very good, but who's going to bridge the gap in emerging markets? So I think besides few outliers of transport and electric transport and renewables, we are not seeing much happening in climate innovation. So I think investors like us are focusing a lot more on that, which has immediate impact on emerging markets substantially in how to build scale. And that's exactly where our blended finance will be more useful.
It's an interesting parallel you draw between venture capital and design funding. Essentially, design funding is the venture capital of transactions that need to exist that don't have that far upside, but really have a strong contribution to make to the field of climate investing. So interesting comparison. I'm going to turn to Shilpa next. So you've been part of several really interesting blended finance transactions, including the TLFF transaction that my colleague Leah just described. And you've worked with a lot of really complex partnerships to get these things done. I wonder if you might want to give us an example of a transaction where you were in on the early stages and how it went and whether it actually did end up in a project or not. Have you been in on design funding moments that either went really well or really had trouble? Maybe just open that up to you.
Sure, Joan. So yes, I would agree to a couple of things that have been alluded in the past, and then let me give an illustration, because I think that's how we can relate to it the most. So number one, we alluded to the fact of scale, and don't ask for scale right on day one. I think that's a beautiful statement that was made in the earlier panel by Omar. The second part is something that Srini just mentioned, that there are sectors that sometimes get a little low priority. And honestly, that's where the blended finance is the most required. The third thing is innovation. It's a crowded market sometimes, so when you see so many, you sometimes get overwhelmed even with traceability experts. So of course, but innovation is something that is going to keep this live, because at every stage of blended finance, you have a lot of stakeholders to answer. And of course, lastly, the most important ingredient, and that's what I'll bring about in my illustration, is coordination and collaboration from day one. If that ingredient is missing, one cannot deliver a structure. So we at BNP Paribas, where do we really come into picture? Whilst I did mention about the fact that we anchor because we have access to all the stakeholders, we come into picture in structuring this transaction. It may not have balance sheet support directly. We may bring in institutional investors, we may bring in specialized investors depending on whether it's going in the private market, whether it's going into a public syndication. So just to illustrate this, let me take an example of an agri space. Srini, you alluded through crop-in. Let's take a crop which has everything, of course, to do with smallholder farmers who are right at the nodal point of this project. Let's take something which is going to be sustainably replanted. It was alluded by Convergence, Leah, in the TLFF facility. This crop takes about 10 to 13 years of life cycle. So we're talking about an end-to-end 10 to 13 years. To replant something, we are talking about no crop for the first 4 years, 3 years, 5 years, depending on the crop. So what are we talking about? We're talking about no cash flows, which are actually in the picture for the first 4 years. We're therefore talking about a financing facility which covers door-to-door 10 to 13 years. So we're talking about long-term financing. Let's put an assumption, but this is actually based on a real case. We start with 6,000 hectares and we have a plan over the next 6 to 7 years and then a decade to go up to 30,000 hectares, 40,000 hectares. So that is where the ability to scale needs to be proven when we start with the 6,000 hectares. So again, reiterating the point, we can start small, where the financing could be as low as even $50 million, $40 million. And you come to the couple of $100 million as you scale up to 30,000, 60,000 hectares. In the interim, what are we looking for? We are looking for livelihoods of the smallholders. We are looking for cash flows for ultimately the bondholders who will subscribe to this long-term financing. Many a times loan markets would not work. We are looking for justifiable returns. So then we say, okay, how do we structure it? For a financing which is longer term, for a financing which entails smallholders, for a financing which is in emerging markets, for something which is clearly a high yield, high risk project at day one, we need to lock in few ingredients at the early stage. And that is what I would typically call the design stage of structuring the finance. Ingredient number one, we need the corporate to commit, have its skin in the game, to take the offtake, which is going to be the sustainable replanted crop. So you need a taker on the face of it. We can't be looking for off-takers once the whole thing is structured. It doesn't work. And I'll elaborate why it doesn't work. We need the public money which believes in the returns that they are anticipating, and therefore will put their skin in the game to boost the rating of the paper, and possibly to the extent. So let's assume that public money comes in with 50% guarantee or 50% hard finance on the table. You're talking about a 100 million bond, which is 50% of that is got investment grade. So what does it result into? You're able to tap long-term investors, you're able to tap the insurance market, you're able to tap the asset management market, so on and so forth. Then you're left with 50%, which possibly has not got the guarantee, and that's where we want private money to come into play. So that could be specific investors who understand this sector, specific investors who understand the impact. It could be, as we mentioned, family offices and the wealth management side of business. It could be catalytic funding in form of foundations. And of course, last but not the least, you would need investors, institutional investors who are ready to go for the high yield portion. Sometimes the beauty of the structure also is that you can segment your investors based on the tenor. So you could have investors which are all in, all throughout. You could have investors which are there for about 5 to 6 years, and you structure the product accordingly. So once again, these are ways of designing, ways of structuring, reducing the risk, improving the returns, getting the confidence of various sets of investors, those which will have different return expectations. And then, of course, tapping on investors where they absolutely need to be very, very safeguarded, and that's where I alluded to the insurance funds. But once again, my point here is that there isn't one ingredient that needs to take precedence, and that's why blended finance transactions take a lot of time. You need the skin in the game of the corporate. I forgot to mention why did I emphasize on it? Because when the corporate actually sources this sustainably grown crop, that corporate will have to pay a premium from the regular amount. And that is where we want the skin in the game. That is where we want the commitment that today, if you were sourcing crop X at $50 a unit, you are ready to pay $100. And that is where we allude to what was mentioned at the beginning of today. You know, the short-term pain, sacrificing the short-term gain. So maybe I'll stop here, and we'll take a little further as we move on. Yeah.
Thanks, Shilpa. What you just heard was the actual work that it takes to put some of these transactions together, and maybe behind that, the why it often doesn't happen is because who is going to spend the time and the money to do that unless there is potentially a source of grants to help you along. So you just described the kind of work that design funding makes possible. So let me turn to Lisa. Can you go back to the transaction you mentioned, the Asia Climate Smart Landscape Fund? Tell us the story about what you put it together. Why did it need early stage support, or what were the things that you faced, the challenges you faced in the very early stages of putting this together? And why were these risks that you needed somebody else's help to deal with and you didn't just take on your own as ADM Capital?
Yeah, thanks. I think Shilpa illustrated really well the challenges of financing in the agriculture space, but I think and the need for premium price and the need for additional support. But I think we need to also step back and look at the why agriculture and remind ourselves that with a projected population of 9 billion by 2050, we need to double food production without using additional land. And already as much as 30% of global emissions come from the sector. In Indonesia, for example, that number is 60%. So there is need for solutions. It sounds complex. The need for partnerships is great, as Shilpa has said, but that is the future of our transactions if we are to get this sector right. There's also, of course, the increasing climate regulation, legal battles, reputational risk, and huge systemic risk. We've heard a lot about systemic risk today from various panelists. And ACLF, we saw the opportunity really to help Asian commodity producers shift to sustainable practices and to manage that risk. And of course, given the climate context we face in Asia of increasing heat and weather events, droughts, floods, this should be core to every business model. This isn't a nice to have. This transition is not something that's optional. It's something that should be core to every business model. Again, going back to the need to manage risk, this is about managing risk. So then, because of the scale of the transformation that's needed to reduce emissions, often our entrepreneurs don't know what it means to make that transition, how they do make that transition, and how to scale that to other companies that they might hold. So ACLF again saw the opportunity to help with that, with that problem statement. And there's no, the sufficient capital is not available. So how did we do it, and why did we do it? Again, we started with a foundation that I set up in 2006 that provided the research, that provided the background, the understanding, a lot of the data in terms of the challenge that Asia faced in agriculture. Obviously, there was a sense within ADM Capital, within the private credit manager, that this was also something that needed additional support, that we couldn't do necessarily by ourselves. We needed to understand the partnerships model. We needed to become sort of conversant in convenings, in building those partnerships. And then, of course, in that sort of, there was that early stage piece, like Shilpa described the sort of the construction period in a smallholder project, that 4 years where there's no income. It was going to take time to build this fund clearly and to establish the partnerships. So there was need for additional support in terms of developing the impact thesis and understanding how a private credit manager could build a fund that would be that would then transition into that would develop a product that was impact focused, and what that looked like. Our fund incorporates targets in gender, land use, better land use management, in emissions reduction. So we just that in itself was sort of a whole new sort of exercise for ADM Capital. So how do we go about that? So certainly the design funding that we've received was critical in terms of developing that thesis. Additionally, incentivizing the private sector to get excited about a fund in the land use sector in Indonesia, which we've established is important, was just as important. So we received we worked hard with DFC to establish a guarantee, a 50% guarantee across the fund at the asset level that allows private sector to get comfortable with default risk in the project. So it was the guarantee product that sort of brought in the private sector. It was the blended finance support, the grant support from Convergence that allowed us to sort of initiate ACLF. And then finally, we have a substantial pipeline of projects in Indonesia. We've also heard quite a bit today about the lack of pipeline projects. We don't see that. We see entrepreneurs who really want to transition their businesses, who have a lot of appetite for this type of funding. They're not receiving this funding from the banks because there's this risk aversion. There's this mispricing of risk and misunderstanding, we would say, of risk in the sector, and unfamiliarity with partnerships. So we saw that, we do see that there's a quite significant opportunity to fund in this area. Some of these projects, on one side, don't have necessarily the understanding of what impact is initially. So there's a need to build in this sort of the impact piece, the understanding of monitoring, the assessment, even the pre-feasibility studies to begin a project. So that has been very kindly supported by some other of our partners, like Partnerships for Forest. And on the other side, there are companies that understand impact but don't necessarily have the strongest financial model initially, or need support in terms of developing a business model that integrates the impact piece. So, and that is important. So also, we've received support for our pipeline projects, some of our pipeline projects, again, from Partnerships for Forest to help evolve the core business and make them bankable. So a variety of options, solutions that have been seminal in terms of getting ACLF off the ground.
So what you're hearing is the amount of work it takes sometimes to come up with a new thing. From the grantor's perspective, I will say that we select for things that are working on large problems, significant, meaningful problems, and structures that we think can be recycled, stolen, used again, and made larger. So I think it's important not to try one-off experiments and then say that was a great transaction, nobody's ever going to copy it, here's your grant. We really, really think forward. I want to go on to the next question, but before I do, I just want to remind everybody that you can send questions over this direction at slido.com. You've got the QR code up in front of you, so have at it. I want to go back to that comment I just made, that these grants have to be more meaningful than the one transaction that they help get off the ground by fueling, you know, the parties like BNP and ADM Capital who work on them. So Maya, let me start with you. From the donor's perspective, the grantor's perspective, what kinds of fields and things do you think that design funding should be leaning into? Is it, I mean, if we were in a climate conference here, is it adaptation? Is it carbon markets? Is it forest credits? Is it trying to capture value in transactions where there are a lot of externalities? What would be your advice to others to follow your footsteps? Or where would you like people to join you even?
Thank you. So, I mean, I think the key challenges that we've identified as we started looking into nature-based solutions and blended finance were three, I think, that I would like to highlight. One was really this lack of track record in terms of developing a business revenue model that integrates impact, and this was mentioned by Lisa just now. The other piece, and that's referring to your question around which area, and that is focus really on adaptation. So really look at how do you integrate community and biodiversity outcomes beyond just mitigation. And the third one that I'll mention is around building enough evidence and data to measure and report on impact. So those, I think, are the three key challenges that we've identified and that we've tried to place our efforts in trying to solve. And we've done that in a few ways. One is supporting those businesses with that revenue model, and I mentioned the example of Fair Ventures in Indonesia. Maybe I'll give another example that is more in the blue carbon area. So really looking at focusing on mangroves as a potential solution. And why mangroves? Because they have a huge potential to sequester carbon, but also they have a great potential to support the transition efforts by shifting more focus to adaptation benefits. So increasing the resilience of communities from natural disasters, but also offering them livelihood opportunities through potential, sustainable aquaculture, to give an example. So kind of focusing on those early stage business opportunities, and with the example from blue carbon. But then the other area that we've explored is leveraging some of our experience in the broader outcomes contract space to try and capitalize on those biodiversity and livelihood outcomes. So an example of a project that we're supporting in Liberia, which aims to support the government's national REDD+ ambitions, so combining revenue from carbon credits with outcome funding from a bilateral donor for social outcomes like education and health, and biodiversity outcomes like improvement in endangered species numbers. So really working with, on the one hand, the carbon credits, and on the other hand, donor funding that is going and wants to support social and biodiversity outcomes, and therefore trying to help justify ultimately a higher carbon price and therefore maximize income for local communities. So that's really building on our experience with outcome contracts. And then working with technical assistance capital to support projects to build pipeline for investors, and there we partnered with Convergence. We've partnered with M40, and you heard the CEO of Earth Security talk to you about his work with mangroves earlier, and looking at different catalyst funds that help in that space as well. The last piece that I'll mention is supporting the research to build the monitoring, evaluation, and reporting piece. So we partnered with a Singapore-based partner called Mana Impact to really identify best practices and key frameworks to develop nature-based solutions projects in the region, but also to develop standards for monitoring, reporting, and verification that can be used across different projects that we support in that space.
Thank you, Maya. Anybody else want to add a different perspective on where you would put design funding, which sectors, which challenges, which market imperfections, where do you think early stage interventions might really pay off? I don't know, Srini, whether you might have some thoughts on that.
I mean, certainly, one of the things, sorry, I just want to add to what she said. Development institutions have to take greater risks, which they are not today. DFIs have to take greater risks, actually. I mean, I'm not sure whether DFIs are really on the cutting edge of risk at this point in time. They could take greater risks. One thing we have discovered in BII is that, look, if there is no way of investing, let's start an entity. We started a T&D, transmission distribution entity in Africa called GridWorks, which gets into the interior parts of Congo. We started another entity for volume guarantees for pharma companies called MedAccess, which is, of course, slightly early stage. So, sorry, I just wanted to add that point. So in terms of specifically answering your question, I would really turn to the climate tech part of it, where we need much more innovation in funding. And, you know, in the sense, I see that there are venture capital funds which are investing, which will bear fruits in the next 5 years. But right at this point in time, for reasons which Maya mentioned, are the high transaction cost and the limited evidence of mobilization of capital and the higher lead times, you know, the investors are feeling a little bit, you know, diffident about investing in this, really. So I would really say that we have to, you know, we need to much more transformational, demonstrable evidence of investing in climate tech, which is what we are focused now on.
Climate tech, okay. Lisa, what are your thoughts?
I guess just back to this question of risk, which seems to sort of stymie everybody. It certainly is an issue for DFIs who feel that they put their heads above the parapet and they get slammed down. Their shareholders perhaps don't have an understanding of what that risk means. But again, going back to earlier conversations about systemic risk and climate risk, I mean, that is fundamental to us all. So really that should be above all risks. And I think it's a challenge for all of us here perhaps to understand why there is that disconnect, perhaps. Risk can be managed. Risk in the agriculture sector can be managed. You look at sectors like palm oil and rubber, which we fully intend to invest in. There is significant perceived risk at investing in those sectors, not because inherently they are challenging, because of the way that they have been managed in the past, the way palm oil and rubber perhaps has been produced in the past. Those are risks, again, that can be managed using international standards, again, the sort of partnership model, making sure that you have people working with you on conservation, on biodiversity. You have it there. It's an inclusive project, so you're integrating community. There are ways to manage those risks. So it's sort of stepping over those boundaries that we've set for ourselves and helping people understand the real risk in the equation here, which is that we have climate commitments we need to meet, and we can't meet those without incorporating a transition in the agriculture sector.
You know, one of the things that's becoming obvious to me in this conversation, since all of you are talking about agriculture and venture tech for ag and adaptation, is that while we have a lot of standard products on the mitigation side, you know, renewables structures, and we all know about offtake agreements, there are not a lot of obvious models on the adaptation side. And so design funding is an attempt by those with catalytic money to step forward and provide a field of experimentation so that we can come up with standard products. One of the questions that just has come in is actually, do we have enough experience designing blended finance transactions to come up with a set of guidelines or an asset class to streamline the process? I would hope at Convergence we're starting to get the hang of having a very streamlined, very logical process for people to come at us with. And I think the SIFI program that we are also co-managing with others is part of that process. But I do think there is an opportunity to get very, very efficient with donor money, with catalytic money, at grinding through proposals and applications and picking things for scale, picking things for replicability, taking big risks and putting them out there in the market. So I appreciate all of the different sort of ideas that just came at me. Let me actually go ahead and turn toward a couple of the questions if I could. You know, somebody is asking, considering the long time and the number of stakeholders it takes to put a blended finance transaction together, to your point, Shilpa, who coordinates, who brings it all together, who takes the lead? So we're all talking about design funding, but to whom? Do any of you want to tackle that? The early stage funding goes to whom to do all the work, generally? What have all of you seen or experienced? I have my views, but let me open it up to the crowd.
Maybe, Joan, I'll go with experience as to how do we come across this and how do we, if I use the word originate, depending on the situation. So for us, obviously, the conversations are clearly with our clients. These are either multinationals or large Asian companies out here. And then in the event of their transition, what we do is we try and understand where is the real transition targeted, at what level in the entire value chain. Now, we spoke a lot about agriculture. Let's talk about electrification of fleet. So I'm just trying to digress into a different sector. Today we're talking about EVizing cities and countries. But if you go all the way down to the value chain, who do we need to encourage to transition? It is the drivers of the tuk-tuks, drivers of carrying the food panda, the ride-hailing companies, the drivers who have to believe in this. What possibly is holding them back from thinking is obviously, as per today, the differentiated pricing where for that denominator, there is not much that he, the driver, or she, the driver, can do to transition and adapt and move into the new format of cleaner mobility. So when you have a problem like this, and when you're talking to a ride-hailing company, you say, okay, you have a fleet of X thousand vehicles, that's your business. Why don't we look at a structure which can embed blended finance, which ultimately, where you play the role of the sponsor, in other words, the equivalent of the off-taker in the agri space, and based on your corporate risk, we design a structure which includes blended finance and actually compensates the incremental costs for drivers. Now, to be very honest, one could think that, can you look at a simple or a synthetic securitization structure at the end of the day? Yes, you can. But what I'm trying to say is that this is applicable across various sectors. The applicability and the ideation depends on to what level of the nodal point are you reaching and where is the real impact and where is the money really needed rather than easily available, because we're talking about where the money is not easily available. And of course, then we are talking about how do you structure it to enhance the credit quality, where banks and structurers would come into play to attract the right level of investors. So I would say this is typically the way when we get into conversations with our corporates to come into picture and play our bit in the catalytic blended finance framework. Yeah.
Yeah, I think in our experience, we've seen everything from banks like BNP Paribas to NGOs like the Nature Conservancy to advisory firms like ADM Capital, all coming at us with proposals. And part of the thing about a design funding window is you hang out a shingle, you describe the kinds of challenges you're interested in, and people come at you that you've never heard of or you didn't realize were working on something. So rather than putting all of your bets in one place, you can open up a window and have a lot of different kinds of people coming at you, and you don't actually have to know where these ideas come from or who is it who's going to work on them all, because they both self-identify and come at you. I don't know, Maya, if your experience has been similar there.
Yeah, I just wanted to add that I totally agree with you. It can be different players, but I think in terms of the characteristics of what would make a player successful in structuring a blended finance product is someone that understands the sector deeply, that has the right networks and ability to collaborate with government, with local communities, as well as with the right types of enterprises. So that's one side of the equation. The other side of the equation is someone that also has an understanding of what structuring might look like. So I think combining those two, I think, essential characteristics will be really critical to finding the right partner to develop these structures. And you could have one lead partner that then, let's say, sub-grants to others that have more expertise, but I think the primary partner really needs to have an understanding across those two areas.
We have one last question for Srini, and then I will wrap up. Srini, how does BII plan to multiply its capital for early stage project development? Do you have a regional or a global aggregator that you plan to back?
Yeah, certainly I think, for all our institution, mobilization is an important theme. I think our idea is to seed companies, bring it up to a certain stage, pre-construction stage, and so that we take greater level of risk that I said. And our ability to mobilize and bring in third-party capital will be a key part of our development. And that's probably, both in Africa and in emerging Asia, we'll try to do that substantially.
Great, thank you. I want to leave you all with a vision of how effective this all is, because it all seems somewhat squishy and early stage and unformed, but we have seen very high-risk, interesting ideas come at us that we've picked, and one of them turned into the Climate Finance Partnership that ended up having BlackRock as its backbone. We did not finance BlackRock, we financed, or we gave a grant to a very small advisory firm who then went on to talk to donors and to talk to BlackRock, who then took it on. So you can, with a couple $100,000, these are small grants, go on to seed something really large. Similarly, we wrote a case study about a very small transaction called the Seychelles Debt Swap for Nature. And then the prime mover there, which was the Nature Conservancy, came at us. We gave them a grant, and they went off and went from that $12 million or so transaction to do the Belize Debt Swap for Nature, which is over $400 million. Again, they did all the work. All we did was say, you've got an interesting structure there that other people can learn from. They did Belize, and now they've just announced Barbados, also several $100 million. So to give you a sense of the path, this very early stage, formative, small ticket money in quite petite windows can really blow the roof off a sector or a structure type that hopefully can really get everybody else excited about doing similar things. So I just want to leave on that high note, because this is all somewhat crucible stage work. It's really hard to describe how you go from that early stage work to the imagination of an entire field that becomes investable and familiar to people. I want to thank all of the panelists very much for all of your interesting comments, and Maya, thanks for dialing in from afar. Would you all join me in thanking our panelists this afternoon?